Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today we're going to be going toward the latter end of that title. We're going to be talking about selling puts for income, but specifically, we're going to be talking about how a technical trader might use charts to plan the timing of those trades. When do we get into those short put positions for income? When might we pull the plug on those trades? A lot to cover. Looking forward to it. Before we can get to any of that, though, let me first of all say hello to everybody that's already chatting in out there in YouTube. Lots of familiar names. Great to see you all. Hello there, Sharon and Will, Scott, Paul, Lawrence, Eva, Bush 8531, Andrew, Tony, everybody else. I never eat here. Thanks for joining us week after week. We definitely appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, we'll enjoy the presentation, but be aware that you're invited to join us in the live show. If you'd like to be here, this is a Monday webcast series. We kick things off promptly at 2 Eastern. Love to have you here in the live audience. Also, as a treat for our live audience members, my very good friend Scott Thompson is going to be hanging out in the chats. Scott and I have now been working together for more than 40 years. That's the case with so many of our coaches. Scott brings a wealth of knowledge and experience to this discussion. Thanks for having my back there, Scott. I also want to give an invitation to everybody watching. If you have an account with X, you should be following your favorite presenters there. Give me a follow on X at Cameron May CS. It is the best place to connect with me in between these live streams. But let's get right into today's topic. We're going to be selling puts for income, but using charts to hopefully complement the timing of that approach. But of course, with options, as with other approaches to trading and investing, risk is real. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including a loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay. So here's what we're going to be talking about today. First of all, we're going to take a look at our current example trades, see if any of those need some attention. I think at least one does. We have 5 positions on in our example paper money portfolio at the moment, so we'll go have a look at those. Then we'll take a quick peek at the markets to set the stage for a discussion of this bullish income strategy known as selling puts. And then we're going to dedicate the bulk of our time to really walking through how a trader might use stock charts to hopefully assist with the planning or the timing of entries and exits on those short puts for income positions. And before we wrap things up, we'll even go plan and place a new example trade in our paper money portfolio. So let's go right to Thinkorswim desktop platform. Here are our 5 current positions: Apple, Abbott, Gilead, Philip Morris, Tesla. See how these things are doing. Most are doing well. Our Apple position not doing quite so well, but actually not doing as poorly as even this might indicate. So starting with Apple. Yeah, right now we have an Apple. We have a covered call, bought 100 shares of Apple. We're in a short call position at the 220 strike with the 18th of July expiration. Sold those for $1.77, or sold that call for $1.77. Right now, it's worth about 77 cents. So we have an unrealized gain of about $100 on that call position. But we've previously sold calls against this as well. So let's go back through the history of Apple. This position actually started off as a short put. We entered into what we call the wheel strategy. Sell a put, if assigned, own the stock and sell calls against that, see if they get called out or just continue to sell calls. But in any case, sold the 21st of March 235 put. That was assigned. So we retained the $3 initial premium. That became a realized gain on that option, but we were sold the shares at $235. Those shares are only worth $210 now. So that's $25. We're $25 upside down on the stock position, but we do have that profit on that put to assist with that. We subsequently have sold a $235 call, realized an 80-cent profit on that. Sold a 230 call for $1.49 profit ultimately, sold a 225 call for $225 profit, and we've sold this 220 call for $177, unrealized gain of about $1 there. So net, Yes, we're underwater on this trade, but we've actually realized gains of about $800. So really overall, we have, what would that leave us? $800, $900, something like that. So maybe down about 1,500, 1,600 on that position. So with that, I think we're just going to let this covered call position continue to work. There still appears to be some meat left on the bone there for that current call position. That brings us to Abbott. Abbott, we just own 100 shares of stock. And I don't remember this webcast series being called Stock Investing. Yeah, covered calls and short puts. This was a covered call position. The call expired. We have a realized gain there. The stock is actually doing just fine all by itself. So here's Abbott, ABT. Bought the shares for $128.68. Stock has gone up a bit. That's helping out the shares. But we sold a 16th of May 135 call. That expired for a 132 profit. Sold a 20th of June 135 call. So our May call position stretched through this period. Our June call position stretched through this period. But we now have a realized gain of what is that, about $3.23 on the two short call positions, in addition to this unrealized gain that we're seeing on the stock position. So that trade is going just fine. But what might the trader do from here? Well, we could sell another call. Does anybody see an issue with selling a call and possibly limiting the upside potential of the stock in the near term here? Well, if we look just around the corner, there's an earnings announcement. So that's really only about 10 calendar days away. For some traders, maybe they might look at selling a call that expires before then. Some traders also might be totally fine with selling a call and carrying it right through the earnings announcement. That can have pros and cons. Limits the upside potential of Abbott, but also can provide a little bit of a cushion if we see a negative earnings announcement. But with this one, I think what we're going to do is just continue to hold those shares through that earnings announcement. If it goes well, great. There's not a limit to how much that we can make if the stock goes shooting higher. On the other side of that, if we get a negative earnings announcement, we do have risk exposure when we own shares over an earnings. So we're just going to hold on to that, make no changes to that Abbott position. With Gilead, this is one where we sold a long-term put. Now, with each of these, if you want to see the logic of these positions as they were initially placed, you can go to our YouTube channel. So do yourself a favor, if you're watching this webcast series for the first time, pop down there in the lower right-hand corner and click on the subscribe button. It only takes a second, doesn't cost anything, but that subscribes you to our Trader Talks channel. And this is where we house our previous webcasts in nifty little categories according to the webcast series. So Trader Talks Schwab Coaching Webcast is our channel name. And if I go to the playlist here, I can find the playlist for this webcast series. This one, scroll down among the others. This one's more toward the bottom. It's actually about 4 lines up from the bottom. So let's just go right to the bottom, then work upward. There's my face. There's trading covered calls and short puts. And this is where we can find that playlist of these other trades. We can go back and understand the motivations for placing those trades. So for example, this one that we're talking about right now was a month ago. We discussed selling long-term puts. Is it an income opportunity? Is it possibly just a trap for capital? So specifically, there's known as LEAPS options, long-term equity anticipation securities is kind of a mouthful name for those. But going back to our position, sold the 18th of June, 2026 put. Still a year left on this thing. Sold it for $310, and we might think, oh, we got to wait a year, 52 months. Well, here we are a few weeks into this trade, and actually sold this for $310. Maybe the trader might be able to get out of it with already a 70-cent gain, something like that. That's a disproportionately large amount in those first few weeks of trading. What's been going on with this? Well, this is a bullish trade. Selling puts is bullish. Let's go to Gilead. And time has gone by. You can see this recovery in price. What the traders would really like to see is for price to go higher and higher and higher. The further this gets above our strike, and you can see how far away that strike is, the more this could actually accelerate the decaying value of that put, that's just what the trader might want. So we'd really like to see this go up. As a matter of fact, we have an order in here to get us out if we can get out for $1.50 or less. So that one's doing fine. We're going to let that one continue to work. Then we have PM, covered call position. We bought the stock at 181.63. It's pretty much what we paid for it still. Sold a call for 140. It's going in the right direction. It's decayed a bit. Overall, though, we're down just a little bit on this trade. We're going to let it continue to work. If it's helpful to see it on a chart, here's that position. Took the position right here. You can see we came down to a previous possible area of resistance. Looks like it acted as a pretty good support this week. So we'll see if the stock can continue to rally. That 187 is the call that we sold. We do have a stop in place. If this stock were to fall down, maybe break through support, go down to 170, we have a stop to get us out of the entire position. And I've set that stop to just expire when we hit expiration. That would just leave us with the shares if it hasn't fallen down that far by then. All right. Now Eva is calling me out saying, hey, that put that we sold is not a LEAPS position. It was, if one is defining a LEAPS contract, a long-term equity anticipation security, that long-term being the key phrase here. If the definition is more than a year, well, there was more than a year when we sold it. There's less than a year now. So we've crossed that magical, mystical threshold where we've gone from a LEAPS contract to just a normal contract. Well, guess what? It actually started off its journey as a normal contract with a fancy name. It was longer term. Yep. Good call out, though. But let's go to our monitor tab. Let's have a look at Tesla. This is the one that I think maybe we do something with this today. Maybe, maybe not. Let's see. See what your input might be. We own 100 shares of Tesla, bought those for $233. Look where that is, $293. That's the current, this is the current call position against that. Sold a 345 call for $9.95. It's only worth 90 cents. So we might be able to get out with about 90% of the original premium retained from what we originally collected. So let's go to the chart. So we bought the shares back here, sold the 17th of April 280 call. That expired for a 249 profit. Held the shares until this date, sold the 20th of June 365 call. Those we closed for a profit of 863. And on that date, what was that? That was June 9th. Closed out here, opened a new position, 345, 18th of July call for 995, and price peeled back. Looks like we're settling in potentially down here at a previous area of resistance, maybe a new support, still above what we paid for the stock. So the stock is doing really well. But our call, the current call position has gone way out of the money. What do we think? Should we close out that position, maybe sell something a little bit closer to the current price? There are pros and cons to doing that. Maybe collect more premium, but also limit the upside a little bit more. So, Eva, that was sold about a month ago, I think. That longer term put. Anyway, what do we want to do with this one? So we sold it for $9.95. It's worth about 91 cents. Now, the nice thing about this situation is 350 is well above, no, 345 is well above the current price. So the stock we've got about $53 of wiggle room to the upside. Oops, I didn't mean to draw something. But if we just want to allow, boy, I'm all over the place here. Anyway, if we just want to maybe stick with this and see if it'll just expire worthless, there's still 90-ish bucks left on the table. Still 90-ish dollars of juice left to be squeezed here. But we might also be able to close that out, say, done. Realized gain of about $9, and then maybe sell a new call, maybe get another $9 or $10 or $8, something like that. There are pros and cons to both of those scenarios. I think I was planning at the launch here to close this out, maybe roll it. I think I'm going to leave it alone. Let's see if we can get this other 87 cents for the bulk of it. That's a high probability scenario, but if the stock rallies, we still have that cap waiting up there. Mark disagrees. Mark said, maybe it might be time to take the juice here. Bob says it's done most of its work. Close it out. Maybe we could even just hold the stock. We don't have to get into a new covered call position. We don't even have to hold the stock. We could just close the whole thing and call it good and have this gain realized in addition to the other gains we've already made. I think I'm going to make some people squirm and say, you know what, we're going to hold on to this. We'll see if that turns out to be the right decision next week. That's what we're going to do this week. But now let's plan and place a new trade for this portfolio. But before we do, I noticed that there is a survey link that's been added to the chat window for the benefit of those that are here in the live audience. We don't get this every time. So if you do me this favor, click on that survey link right now. That'll populate the survey. You can just park it and fill it out when the webcast is over. You can give me some honest feedback. But I just want to tell you a little bit about that survey. If you've never filled out one of our surveys before, they're really short, 2 multiple choice questions, and then a little comments box if you want to leave some comments, and a suggestion box if you have some ideas for maybe future webcasts. But here's what I would say. If you take the time to fill out that survey to whatever extent, I always take the time to read through those comments. I read through the data, and it helps. So it's never a wasted effort, okay? Greg says, don't be greedy on that Tesla position. Well, Greg, I don't know which way I quite define greedy. I definitely see your point. Trying to get that other $87 or whatever there is at the moment, that might be greedy. But might we also say, well, closing that out and then selling another one, trying to get a larger premium, but at maybe the risk of having to lower our strike price, that by some might be seen as the greedier move. Greedy is kind of in the eyes of the beholder. But I'm going to leave it there. Okay, here we go. I thought I was going to make a change, decided not to. Let's go plan and place a new trade. Let's first of all have a look at what's going on with stocks. And this is the first step for some traders when they're using charts to hopefully supplement the timing of their selling puts for income approach. Their very first chart they might look to is one of the major market indices. It might be the S&P 500 if they trade a lot of those kinds of stocks. Maybe it's the NASDAQ or something else that's representative of the sorts of stocks that they prefer. But this is just sort of a technician, a technical trader, a chart user trying to get their bearings on what's happening with stocks in general, because selling a put is a bullish strategy. Yes, it's an income strategy, but explicitly it's a bullish income strategy. And so maybe we want to see some indications of bullishness on a chart. Well, we're not getting that today. We have this one sort of fearsome looking red candle that's brought the S&P down 1%. We're just about 1% off all-time highs on the S&P. So in the grand scheme of things, a technician might look at this one red candle and say, yeah, it's not optimal, but still, maybe stocks look pretty good. Could this be the start of a big sell-off? It could be. Maybe somebody's looking at those tariff tensions and they're concerned that maybe the sunsetting of the tariff deadline, the tariff extension deadline, maybe that's going to disrupt markets on Wednesday. We'll see. Maybe there's going to be an extension to that extension or that pause. Maybe they're not happy with the tug of war back and forth between the executive office and the owner or the founder of Tesla. Maybe, I don't know, maybe they don't like that OPEC just announced that production is going up and oil prices might be coming down, and that could put pressure on that energy sector. Who knows? But in any case, bottom line, a technician might consider all that and may conclude, we're still just a percentage point below all-time highs. If we do pull back, maybe there's going to be some support above those all-time highs. And let's just say that their overall outlook as they're planning, maybe let's plan a trade out here for August 15th. So we're trying to just get our best gauge. Do the markets look more bullish or more bearish through August 15th? Let's say that our trader thinks that maybe this is going to happen. Let me switch up my drawing tool. Let's put up our trend line tool. Maybe they think we're going to pull back a bit more, but then start working our way back higher again. Not perfectly higher, but just sort of stair-stepping higher. Is that exactly what's going to happen? Nobody knows for sure. Let's just say that's our trader's outlook. And looking at a chart of a major index might have assisted with this timing. They might think to themselves, this actually looks okay. So let's go do a bullish trade. Well, what about looking at the stock chart? I didn't mean to go to the trade tab just yet. Let's bring up an example stock chart. So for today, I'm going to use Salesforce, and this is going to be a little bit different, maybe for those that prefer a strongly and continuously upward trending stock. What do you notice about Salesforce most recently? Well, it's actually not had the best of years. It's a little bit above its starting point from 12 months ago. But going back to late 2024, we had some selling off. Let's establish a potential list of priorities for that would-be short put selling income trader. All right. What might be priority number one? It may be to establish the trend. We've already looked at an index and determined that stocks overall look like they've been bullish. This one, though, maybe a little bit iffier. There are a couple of ways that a trader might identify a trend. First of all, they might look at highs and lows, because stocks and indices tend to move in little patterns. So for example, as we hit a peak here and we started to sell off, you'll notice we didn't go straight down, but instead moved in sort of waves, short-term waves, running down to lows and pulling up to highs, and running down to lows and pulling up to highs. Well, so a trader who's looking to do something that's bullish may have looked at this period where those highs and lows were going lower, stair-stepping downward. That might not be the best condition. However, what have we seen more recently? Pulled down to a low, but that low is higher. Raced up to a recent high, that one's higher. And then we pulled down to another low, got a little bit jagged here, but overall, maybe working our way higher. Now, doing this sort of manual analysis is the preferred approach of some. For others, let me just clear this whole drawing set. They like to use tools that can sort of sift through this in a mechanical way and provide more automated analysis. So I'm going to use a technical study known as a simple moving average. And this isn't going to be a huge. All right, I'm going to be doing some chart analysis in a couple of steps. For the trend analysis, let's stick with pretty familiar territory. And then in the next step, we're going to go out maybe a little into an uncomfortable or unfamiliar territory for some. All right. Let's add our simple moving average for our short put approach. Not every short put trader does the same thing, but typically they're trying to strike a balance between selling a put that's far enough out in time that there's enough premium to make it worth their while, but not so far out in time that they're giving the stock lots of time to misbehave. Now, we've talked about how sometimes traders go way out in time. But for the most part, for some traders, they prefer to maybe sell, maybe a couple of weeks to maybe a month or two, somewhere in that sort of a range. So if we're in that relatively short-term time frame, which trend might the trader be emphasizing? Probably something short-term to intermediate. So I'm going to choose a trend length on our simple moving average of 50, just as representative of this charting approach. Let's click apply and click OK. And so this may be sufficient if our simple moving averages, if average closing prices are going higher over time, despite day-to-day choppiness, maybe our trader is still okay seeing this as a bullish trend. On the other hand, if average prices are heading downward, maybe they see that the trend might be downward itself, and this might be an inappropriate time for those sorts of trend traders to be entering into new bullish strategies like selling a put for income. Now, Mark says if you're a believer in triangle patterns, you're looking at multiple overlapping triangles here. Yeah, you can make that case right here, Mark, right? I'm not going to go too far into that, but yeah, lots of different ways that a trader might look for technical confirmation of bullishness, or not confirmation, maybe a contradiction. But in any case, what's going on with our moving average right now? The stock is choppy, but overall, average prices have been rising relatively recently. So there may be a new emerging trend here. We'll see if that continues. But let's put a little check in the box for our trend trader and say, Looks like there's sufficient bullishness, at least in the short to intermediate term, to drag that trend line higher. That's one technical approach. That might be priority number one in planning a new bullish trade. What might be priority number two? Well, now it might be timing within that trend. And lots of different ways that a trader might look for timing assistance. But one indicator that I've discussed in a couple of recent webcasts is called the TTM squeeze. I'm not going to go deeply into how this indicator is built. It really is a volatility indicator that looks for times when a stock gets really pretty stable, where it kind of goes through a period of consolidation. And that is sometimes seen by traders of using the TTM squeeze as sort of the calm before the storm. The storm here being maybe the stock is about to burst higher out of that little consolidation, maybe out of that sideways pattern. So I'm going to go up here, click on our little edit studies icon. I know that probably most of you have not seen the TTM squeeze. Well, maybe the live audience, a lot of you have seen it. I would suspect for those that are watching the archive, that ratio is going to go down. Probably a lot have not seen it. But let's add this to our chart and click apply. I just want to talk about basic interpretation of the TTM squeeze. The real focus here for a typical TTM squeeze trader, Isaiah said you really enjoyed my video on TTM squeeze. Yeah, what you can do, if you haven't seen this, go to our channel. I'll just go right back to square one here so you can see. So here's our channel, and just type in TTM. Just do a search, and you'll see a couple of videos that I've done on this recently. But there we go, TTM squeeze, planning an entire stock trade with just one indicator. But in that one, I go a little bit deeper into how this indicator is built. All right, but basically, the TTM squeeze trader first will typically look at a trend indicator. Not always, though. Sometimes they trade this just in isolation. But then they'll look at the series of dots, and it's kind of hard to even see this. So let me zoom in on this so you can see the individual dots. So down here on our oscillator, you'll see this series of dots, green dot, green dot, green dot, green dot, green dot. When we start to see a series of red dots, what this means is that it's typically interpreted this way: the stock has gotten really quiet. It's staying in quite a narrow trading range. Explicitly, for those who really want to know, it means that the Bollinger Bands have gotten so narrow they're trading inside of some Keltner channels. Ooh, I don't know what that means. That just means the stock has gotten quiet. Well, under the assumption that a quiet period typically doesn't last forever, this may attract the trader's attention. And really, it's not just one red dot that's sufficient. That just means it's gotten quiet for a little while. Typically, we're looking for at least 4. Some traders even prefer at least 5 red dots, meaning an extended quiet period. And then when that transitions back to green, that might signal, hey, this stock is on the move again. You might see right here is the quiet period I'm talking about that created this series of red dots. And when we get that first green dot, sometimes the quiet period ends with a move upward. Sometimes it ends with a move downward. This is where these histogram bars come in. If we see a blue bar laying on top of our green dot, that means that our breakout from our quiet period is probably bullish. And for a TTM squeeze trader, they might expect that a nice bullish move is about to start from here. All right. So is that a guaranteed signal going to work every time? No. It is interesting, though. Let's look at this one back here. So these were the 4 dots we were just highlighting, and they did precede a nice move to the upside. And if we put ourselves in the shoes of a bullish income trader, maybe somebody, like, let's say they sold a put, quite likely that put went so far out of the money right there, it may have presented opportunities to take quicker profits than expected. Now, that's the way it worked out that one time. Myron says, how do we get those dots? So Myron, in this case, we just added the TTM squeeze indicator. It's one of our technical indicators found right up here under the edit studies. So you come up here, just type in TTM and choose TTM squeeze here, add it, click apply, click OK. All right. So let's take what we just learned there. And by the way, this can work the opposite direction as well. If we get three, or if we get a series of red dots and then a green, but it's not a blue bar, if it's a yellow or a red bar, watch out, that may signal the stock is ready to go down. That's the opposite of what a typical put seller would be looking for. Well, here we have a series of green dots and, a series of red dots, 1, 2, 3, 4, 5, quiet period. And now we're starting to move to those green dots again. You might be a couple of days late. That's okay. For the purposes of this illustration, I'm fine with that. But let's say that our trader has noticed, oh, our trend is starting to go higher. We're starting to get a bullish signal from our, in this case, let's just call this trader's preferred technical indicator. Maybe it's time to sell that put. So step number 1, trend identification. Step number 2, maybe a technical indicator to assist with precise timing within that trend. Now, precise is kind of a loaded term. It makes it sound like it's perfect. Precision doesn't always mean perfection. Nope. It just means we know what we're looking for, and either we see it or we don't. Now, the third thing that the trader might be planning for is this thing might not work out. And so priority number 3 might be planning the exit if the trade fails. Now, one of the things that a trader of the TTM squeeze will commonly do, and let's go back here in time again and learn from this. Let's zoom in on this time frame that led into our signal. The moment we get that green and we decide to do whatever we want that's bullish, maybe we're buying a stock, maybe we're selling a put, something along those lines, they may look to the time that led up to that signal and look for what we call support. We're just looking at recent price floors. And here, it looks like there is a recent price floor leading up to that signal, probably somewhere around there. Essentially, what they're doing is trying to draw a line in the sand. If we're getting into a bullish trade, well, then how do we know, when do we know when we're wrong? What might the trader see on the chart that contradicts what we thought we saw with the trend, what we thought we saw with our timing indicator, and maybe we just need to pull a plug? And that might be the support level leading up to this breakout, the support level through the quiet period. So if that's the case with the current, let's go apply this to the current scenario. Let me look at this. Let me let you look at this. Just do some squinting here. Where do you see price floors or support leading up to that first green dot that we got just a few days ago? Mighty Quinn says, is there a minimum number of blue bars over green dot days to look for? Nope, Mighty Quinn, it would just be first green. Is there a blue bar there? If there is, that's the signal. Good question. Where do we see a possible support? Can we throw out some potential numbers? What do you think? Well, if I look at this green dot, it looks like it lines up with that red candle. So where was support leading up to that? Looks to me like the previous support was around that 260 level, maybe a shade below, maybe 258. There can definitely be a difference of opinion regarding precisely where those price floors are. But can we make that argument? Does that look like, yeah, Greg says around 260, right? 260, 258, that's within 1%. Whether, one trader A takes the one position, trader B has the other opinion. We're really kind of splitting hairs there. So what the trader might conclude here is, well, I think this is going to go up, which could be beneficial to something like a bullish put position. On the other hand, if it goes down, if it starts to break below that level, maybe it's time to pull the plug on that trade. So maybe we say if we get down to 255, maybe somewhere down here. Let me just extend that out to, let me do this manual. Let's activate this drawing. I'm going to pull that out here to expiration. Just to help us visualize this, if we start to break below those lows, it's not behaving bullishly. Maybe we don't want to be in this short put anymore. Now, another benefit of identifying these support levels is that may assist with the strike selection of which put we choose to sell. Because if we think that the stock is likely to, let's say we think it's likely to stay above 260, just to go back to Greg and Kevin and Gautam, their suggestion, if we think that it's going to be above 260, even if it comes down, maybe it's going to touch off 260 and go higher again. Maybe that's the put the trader considers selling. Well, let's do that. Let's go to our trade tab. Let's go out here to August. Make sure that we're looking at the right stock. So we are on Salesforce. And I'm just going to see. Let's go see what we could possibly get if we were to sell. Let's see. The 260. Yep. 260 put. What's that trading for? That's trading for just shy of about $6, $5.75 to $5.90. So if you're not entirely comfortable with just exactly what we're doing here, when we're selling a put, we're accepting a payment. In this case, it's around $600. And in exchange, the trader has an obligation. Someone else out there has the right to sell shares to that trader for the agreed upon price of 260. We're striking a deal where we have the obligation to possibly have to buy shares for 260. Well, under what conditions would someone else want to sell us shares at 260? Well, if they couldn't get more than 260 somewhere else. Right now, they can sell shares for more than 260. So if the stock is above 260, which is where it is, and which is where I think it's going to be through August 15th, maybe we can just collect this premium and hopefully it just expires worthless. That is a bullish. Now, Gautam says I would do a bull spread. We could, but this webcast series, I won't do a spread here just because this webcast series is literally called Covered Calls and Short Puts, right? Selling puts and covered calls. So those are the two strategies we limit ourselves to here, but that doesn't mean that there can't be other strategies that might be implemented on the same technical set of evidence. All right, so with one charting step, we've accomplished two big things. We've selected a strike price to sell, and we've determined when we maybe just decide to get out of that trade. So let's do this. Let's click on the bid price. And I'm just going to sell one contract as our example today. Selling that one, 15th of August, 260 put. Let's see. Looks like we're trading between 570, 575. Let's just stay with 570. I'll submit that as our limit order. There's still a risk the order might not fill, but we'll see. Selling that one put, trying to get 570, that would be a $570 profit. When we sell puts, there is significant risk potential, right? If the stock collapses in value, we have the obligation to maybe have to buy the shares for 260. So if those shares go down to 250, 240, 230, 220, 210, we still have a contractual obligation to buy those shares for 260 for as long as we're in this contract. So there is a commission to be paid here, 65 cents. So that chips away at the potential credit, takes it from 570. If we get that down to 569.35, but let's see what we can get. Let's click send, see if we get this filled. Go to our monitor tab while this is waiting. Go up, there's our, I was going to go to our working order so we could check on it, but it looks like we sold that for 580. So we just got paid $580 minus 65 cents. So $579.35. But through August 15th now, what are we hoping for? Well, we're hoping this trend persists. We're hoping that our bullish signal here on TTM squeeze proves accurate, and then we're starting to move to higher levels. But if the stock starts to pull back, maybe we want to get out if we drop down to that 255 level. I typically put in an order to exit at the same time of order entry, but all the time I get this question, can I do that after I've already entered the trade? Yep, we can. Let's go to the monitor tab. Let's go to our new Salesforce position, and I'm going to right click on that and create a closing order to buy that contract back. Now, I don't want to buy it back right now. Instead, I want to buy it back under the condition that it's fallen down to or below 255. So how do we put in a condition like that? Here's what we do. First of all, we tell it right here. We could do this on the next screen, but I'm going to do it here. Let's just say we want to sell. Market value, if it slips down to 255, we don't know how much that put will cost us to buy out. If it's fallen to 255, we just want out. But now let's add our condition. First of all, we want this trade to be good till canceled. And we want that condition to be if the value of Salesforce, we just click under the word symbol, and it'll automatically populate with our underlying symbol, CRM. If the market value of Salesforce falls to less than or equal to 255, type in 255 there. What do we want to have happen? If the market value of Salesforce falls to less than or equal to 255, then this happens. So this is the condition, and this is what we want the condition to trigger. Buy that one contract back at whatever the market price is at that future date, if we happen to fall down there. And we'll just leave this good till canceled. Send this order off. Well, probably we'll save that. Then click confirm and send. Going to buy this back. Buy that 260 put if CRM falls to or below 255. Now, we don't know how much, again, I got to emphasize that, don't know how much it might cost us to buy that put back. It could be substantially more than what we paid for than what we received from the premium when we first sold it. But the objective here is just to stem the bleed. All right. Now, due to potentially wide market conditions or markets or liquidity risks at the time of activation, if we've dropped down to 255, that would activate this order. This order may be manually substituted with a limit order upon activation and worked until it's filled, right? But there is a commission here. If this order gets triggered and filled, there'd be a commission to pay there. Let's send that order off. There we go. But with that, we now have a plan for this trade, and we did it with the assistance of charts. So I've walked us through just one example process: trend, a timing signal from a technical indicator, then identifying support. And that support can assist with identifying when to get out of the trade, but also potentially even strike selection. So Adani says if the stock goes down, instead of getting out of the put, might we just roll it to a further position in the future, hoping it will go back up? That's a possibility, but rolling unprofitable trades what it does is it closes out of one trade that's maybe not going so well, gets us into another trade that may go better, but that's only if the stock then starts going up. If it continues going down, that may pile on loss upon loss upon loss. So rolling, it's not a perfect solution. It carries potential rewards and potential risks. All right, so everybody, we've accomplished what we set out to do today. We looked at existing positions. We looked at the markets, we placed a new trade, planned that short put income position using stock charts. I hope you enjoyed this discussion. This is what we do on Mondays. You're certainly invited to join me again next Monday, or just keep your eye on this Monday series. You can watch the archives, just watch the recordings. That works just as well. So also, I want to issue the invitation to you, if you're not following me on X, you should be following your favorite presenters on X. This is the best place to connect with us in between these live streams. You can just get input from us about, maybe important developments in a given day or week. You can also provide feedback. For example, I just threw out this sort of heads up. Hey, we've got some big things happening regarding tariffs this week. What do you think is going to happen with those? All right. But thanks for giving me your time today. Thanks for all the thumbs up that I'm already seeing. 176 people watching the live stream. I see 52 have already clicked the thumbs up. That is always appreciated by your presenter. It gives us a boost in the YouTube algorithm. It's also a nice pat on the back for a job well done. That's the way that I take it. Final thing, if you haven't clicked on that survey link yet, please do that now. Fill out that survey. I will definitely read through your comments. I definitely read through that data. It always helps. It's never a wasted effort. All right. Thanks, guys. Go have a good time watching the rest of our webcasts. I will see you In my other webcast series, I have something new every day of the week, so I'll look for you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.